Hello dear student, I Professor Agam Dalal from JK Shah classes welcomes you all. This video is for those inter-CA students who are going to appear in May 24. Either the students who are appearing for the first time or the students who could not clear up to November 23. For all of them, this video is applicable. Let me tell you, this video is on statutory updates which is applicable in your attempt. Now when I say statutory updates, it means the statutory update PDF which is recently issued by ICAI on Board of Studies portal. This video is to explain those amendments. However, this video do not cover the amendment which are already incorporated in study material of ICAI so far as May 24 attempt is concerned. Those amendments with regards to budget, those amendments with regards to Finance Act 2023, we have already discussed in the lectures itself, or in the fast track we will be discussing. However, this video is for those amendments which are not discussed in the classroom because ICAI study material was not having these amendments. It is issued either by CBDT as a circular later on, and that's why ICAI has issued a separate statutory update for May 24 examination. As you can see over here, this entire statutory update PDF of 18 pages there. We'll be covering this 18-page PDF and I have made a summary also for this, which we'll be discussing now onwards. So yes, I have already written over here, it is for all May 24 inter students, but it do not contain those amendments which are already added in your study material. For example, up to November 2023, 115 BSc slab rate was up to 250, 5 lakh, 750 like this. From May 24 attempt, it's like up to 3 lakh 0, 3 lakh to 6 lakh 5%, 6 lakh to 9 lakh 10%, so on and so forth. These amendments I have not discussed over here because it is already there in ICAI study material. This is all with regards to this statutory update PDF. One by one, in which all chapters amendment is there. First of all, chapter number 4 that we discuss generally, salaries. Very important amendment. And I predict this in your examination. First of all, let us discuss what was there. If we discuss Rule 3 Sub-Rule 1, valuation of perquisite in respect to rent-free accommodation, unfurnished accommodation, then how to value that perquisite? If government employee, then whatever is the license fee as per government rule, that will become income. If it is non-government employee, then we have to see that accommodation is owned by employer or not owned by employer. If accommodation is owned by employer, population is up to 10 lakh of that city, then your accommodation ki value will be 7.5% of salary. If accommodation is more than 10 lakh but less than or equal to 25 lakh, then it will be 10% of the salary. If the population is more than 25 lakh, then the value of your accommodation will be 15% of your salary. Now what is the meaning of salary over here? Basic salary plus DA, which is forming part of retirement benefit, plus bonus, plus all kind of commission, fixed percentage of turnover, percentage of net profit, plus all taxable allowances. However, this population we had to see as per 2001 census, because Rule 3 Sub-Rule 1 was saying that see the population as per 2001. If accommodation is not owned by employer, he has taken from some other third party on a rent and giving to employee, then what will be taxable perquisite for employee? It will be lower of actual rent paid by employer to the owner or 15% of salary of the employee, whichever is lower. That will become the accommodation value. This will continue up to 31st August 23. Means whatever accommodation is given to employee up to 31st August 2023, that is April, May, June, July, August, for those 5 months, accommodation value will be decided same as per the rule which I just read out. But the accommodation which is given on or after 1st September 2023, so whatever is the accommodation given from 1st September 23, now there is an amended Rule 3 Sub-Rule 1. Now calculation to be done separately. So if let's say one accommodation is given to an employee throughout the year, now you have to do two bifurcation. From April to August for 5 months, calculate salary of 5 months and apply this percentage which are given. But from September till March, that is for remaining 7 months, we have to apply salary of 7 months and we have to apply this percentage which I am going to discuss now. So April to August, old provision, September to March, this new provision. Now what is the new valuation rules so far as accommodation is concerned? If you are a government employee, same, license fee as per government rules, there is no change. If you are a non-government employee, then again there can be two things, accommodation owned by employer, not owned by employer. If it is owned by employer, now see the population of the city, but this time it is not 2001 ka population, it is 2011 ka census. The year changed, first change. Second, if the population is up to 15 lakh, so you can see over here that over here it was up to 10 lakh. Now they have increased the population up to 15 lakh. It will be 5% of your salary. It will be 5%, which earlier was 7.5%. Now it became 5%. If population is more than 15 lakh but up to 40 lakh, then valuation will be 7.5% of the salary. And if the population of the city is more than 40 lakh, then this amount will be 10% of your salary. So earlier which was 15%, now reduced to only 10%, which was earlier 10%, now reduced to 7.5%, which was earlier 7.5%, now reduced to 5%, and the limit also changed. So up to 31st August, let me revise it once. If the population is up to 10 lakh, 7.5% of salary, 10 lakh to 25 lakh, 10% of salary, more than 25 lakh ki population, 15% of your salary. From 1st September, if population is up to 15 lakh, 5% of the salary, 15 lakh to 40 lakh, then 7.5% of salary, more than 40 lakh, 10% of the salary. Salary definition remains same. Now what if accommodation is not owned by employer? Whichever is lower will be taxable to employee. Actual rent paid by employer to the owner, or 10% of salary, which was earlier 15%. Now just because over here also maximum is 10%, here also maximum is 10%. So this also changed now, but this is with effect from 1st September 23. As I said, if you are supposed to calculate accommodation value for the entire year, up to 31st August for 5 months you have to apply old provision. For remaining 7 months you have to apply new provision. So for that 5 month, calculate salary of that 5 month and then apply that old percentage. Then calculate salary of remaining 7 months as per this definition and apply this percentage. I'm predicting any question in your attempt so far as this amended provision is concerned. One of the most important amendment from entire statutory update is this, and one more which is coming. But there is one more thing. Now this thing is not applicable to you people, but still I'm teaching as of now. It can come in MCQ. What further they are saying, if after previous year 23-24 to the same employee, a company is giving the same accommodation for second year. So 23-24 is counted as first year. Now let's say Mr. A is an employee of ABC Limited. In 23-24 company gave him a accommodation. In 24-25 company gave the same accommodation to Mr. A. Now in the year 24-25 Mr. A, how he will calculate value of his accommodation? So first he will apply the rule and he will calculate what is the accommodation value as per the rule. Or what he will do is, he will calculate indexed value of his perquisite valuation which was there in 23-24. So let me give one example. So if to the same employee Mr. A in 24-25 also same accommodation is given, then how he will calculate the value in the year 24-25? What he will do? He will calculate the salary of the year 24-25. He will apply 10% or 7.5% or 5% of the salary as the case may be. Let's say the value is coming to, for example, 50,000. Let's say the value is coming to 50,000 rupees. That is option number 1. Option number 2, he will also see that what was the perquisite value in the year 23-24 and he will do indexation on that to bring it to 24-25. So he will multiply it. Let's say in the year 23-24 the accommodation value was 30,000 based on the salary of that year. He will multiply it with CII of 24-25, divide with CII of 23-24. So what is the indexed value of that perquisite? Let's say this value comes to 35,000 then what will be perquisite value of 24-25, whichever is lower, 35,000. But this rule is applicable for 24-25 onwards, because 23-24 is the first year. In this, we don't have this indexation wala rule. That's why I said that this rule is not applicable to you people, because in your exam, which financial year will come? 23-24. But in MCQ, they can ask any kind of question based on this theory. So remember, if to same employee, same accommodation is given in subsequent year, if accommodation changes, then this rule is not applicable. If to same employee, same accommodation given in subsequent year, that is after 23-24, then value of perquisite will be valuation as per rule, or valuation of 23-24. Base you have to take 23-24 ka, multiply by CII of the year of calculation, that's let's say 24-25, divide by CII of the year 23-24, whichever is lower, that much will be taxable value. But this rule is applicable from previous year 24-25 or onwards. Up to 23-24, this rule is applicable. Are you understanding this, people? So that was an accommodation perquisite rule change, which is very important for your exam. Then in PGBP chapter 1, small clarification is there. You remember section 35D, certain preliminary expense to be amortized over 5 years, feasibility report, engineering study report, etc. In that, we have to file a form containing that which expenditure is there, the details of that form. Now that details up to when it is to be submitted, it is to be submitted on or before first 1 month prior to the due date of 139 subsection 1. That is, let's say the assessee is audited assessee, the due date is 31st October. This form is to be filed up to 30th September. Like audit report to be submitted, in the same way this form is also to be submitted, this statement also to be furnished on or before 1 month prior to the due date of 139 subsection 1. Not that important. Then in the chapter IFOS, yes, it's a great amendment applicable to you people also. Let me go to the base first of all. It must have been discussed in the classroom, but still. In deduction chapter, you must have studied a section 80C. And in that, the first deduction is life insurance premium. If the policy is taken up to 31st March 2012, how much deduction is allowed? Up to 20% of sum assured. For disabled person also 20% of sum assured. If the policy is taken in the year 2012-13, it is 10% of sum assured for both normal person also, disabled person also. If the policy is taken on or after 1st April 2013, for normal person deduction is 10% of sum assured, but for disabled person it is 15% of sum assured. Now, what about maturity of life insurance policy? Section 10 clause 10D, which says that any maturity of life insurance policy is completely exempt. But in 3 cases it is taxable. First case, if it is related to a dependent person under section 80DD, maturity will be taxable. Second, keyman insurance policy, maturity will be taxable. Third, very important, if you have paid the premium which was more than 10% or 15% or 20% of sum assured, if the premium was paid is more than this limit, whenever the policy will get matured, it will be taxable. If the premium paid is up to 10%, 15% and 20% of sum assured as the case may be, maturity is exempt. If the premium was paid was more than the limit, maturity will be taxable. In case of death, it will be exempt. In case of death, if relative are getting this maturity, it will be exempt. Now understand, many people in our country invest in life insurance policy. They don't just take it for risk coverage, they invest. Because compared to the premium paid, what maturity they are getting, IRR is generally 8-9% also. So many high net worth individuals, they don't invest in FD, they invest in life insurance policy because they are getting good return, and that return is completely exempt as per 10 clause 10D. If they invest in FD, interest income will be taxable. If they invest in life insurance policy, maturity will be exempt, and that's why they took the benefit of this provision. That's why Nirmala madam made an amendment, inserted a proviso in section 10 clause 10D. If you take any life insurance policy other than unit linked insurance plan, for ULIP, CA final will learn one more thing. As of now, it is not there in your syllabus. We are not discussing it. Any life insurance policy taken on or after 1st April 2023, when it is issued on or after 1st April 23, and if the annual premium of such policy or policies, so if one policy is issued, policy, more than one policy issued on or after 1st April 23, total premium of all such policies in a year exceed 5 lakh per annum. If the premium paid in a year is more than 5 lakh per annum, it's big policy. Yes, maturity amount will be taxable. The surplus will be taxable in IFOS. It will be taxable in IFOS. So now high net worth individuals, you invest in FD, interest is taxable. You invest big amounts in life insurance policy where the annual premium is more than 5 lakh. Even that maturity is also taxable. You are same now. But if in case of death, this amount is received by relatives. If it is received by relatives in case of death, it will be still exempt. In case of death, if it is received by relative, it will be still exempt. Second point, if any policy issued on or after 1st April 23, total premium of all such policies which are issued on or after 1st April 23, the premium do not exceed 5 lakh, then the taxability depends on these three criteria only. That whether 10-15% more than that was paid, then taxable, otherwise not taxable as per the old provisions. But if the total premium of such policies is more than 5 lakh, then it will be totally taxable. You don't have to see this percentage, then it will be taxable. Maturity will be taxable. See what I have written. As per section 10 clause 10D, maturity of life insurance policy is exempt. But if premium paid was in excess of 10, 15 or 20% of sum assured, maturity will be taxable. One more exception provided to this exemption. Any life insurance policy taken on or after 1st April 23 whose aggregate premium exceed 5 lakh rupees per annum, maturity of all such policies will be taxed other than at the time of death. Any policy issued prior to 1st April 23, for that 10, 15, 20% wala rule only applicable. So now, how it will be taxable, by the way? Surplus will be taxable. Now what is the meaning of surplus? Maturity minus total premium paid till date for which no deduction has been claimed up to now. A very fantastic thing. Again, CBDT has given a circular. Let's say a policy taken 3 years, premium paid 1 lakh, 1 lakh, 1 lakh. Out of this, let's say 2 lakh, 2 lakh, 2 lakh. Out of this, can I say each year I have claimed 80 CICA deduction, 1,50,000, 1,50,000, 1,50,000. How much deduction I could not claim? 50,000, 50,000, 50,000. Now this policy is getting matured and let's say the amount is 10 lakh and let's assume it is taxable. Because I have paid in a single year premium more than 10% of sum assured, you see. Maturity is taxable. From this, how much will be taxable? Total 10 lakh? No. This 10 lakh is maturity. From that you have to deduct premium paid till date. So basically surplus is taxable. Premium paid till date is 6 lakh. You can't deduct 6 lakh because from that every year you have claimed 150, 150, 150. Total 4,50,000 deduction income tax has already given you in those respective years. How much deduction income tax could not give you earlier? This 50, 50, 50. Total 1,50,000. Then now from maturity only this 1,50,000 will be deducted and not total 6 lakh. So how much surplus will now be taxable? 8,50,000. Under which head it will be compulsorily taxable? IFOS. So in IFOS section 56 subsection 2 clause 13, how much surplus taxable? Maturity minus premium paid up to maturity which is not claimed as a deduction in any provision of the income tax. Remember, while looking at the limit of rupees 5 lakh, that if premium is more than 5 lakh, maturity is taxable. You have to see this 5 lakh exclusive of GST. So let's say my premium amount is 4,95,000. With that GST is added, total I am paying 5,02,000. It is not exceeding 5 lakh. I have to see the amount prior to GST. It is less than 5 lakh. Then the maturity will be exempt. Second, the limit of 5 lakh is not applicable if that life insurance policy is a term life insurance. What is term life insurance? Purely risk coverage, in which maturity is compulsory at the time of death. It will be received compulsory by relative. You will never get it during your life. So that policy ka premium is not to be added while calculating this 5 lakh ka limit. Whatever policy you have taken on or after 1st April 2023, if total premium of such policy is more than 5 lakh, maturity of all such policies will be taxable. But if in that policy, any policy is term life insurance, that is the insurance of which maturity is compulsorily to be received on death by relative, that policy to be ignored for calculating this 5 lakh wala limit. Maturity of that policy is also exempt. The premium paid for this is not to be counted in the limit of rupees 5 lakh. But one more thing is there. Government said that, let's say on 1st April 23, on or after 1st April 23, I issued 3 life insurance policy. Premium of all this are like this: 1 lakh rupees of first policy, second policy premium is 3 lakh, third policy premium is, let's say, rupees 4 lakh. What is the total premium of all such policies which is issued on or after 1st April 23? Total if I do, then it is 8 lakh. That is more than 5 lakh. Yes, this amendment is applicable. Maturity of life insurance policy will be taxable. But one small concession is also there. Whether all these 3 policy ka maturity will be taxable? No. For calculating the limit of 5 lakh, I have to see all these 3 policy. And if it is more than 5 lakh, policy maturity will be taxable. But those policy ya policies whose total premium is less than or equal to 5 lakh, you can give exemption to those policy. For example, here if I see policy 1 and 2 ka total, 1 and 2 ka total is 4 lakh only, then I can say that, see, total premium is more than 5 lakh, taxability is there, but policy 1 and 2 ka total is only 4 lakh. Those 2 policy will not be taxable. Policy number 3 will be taxable. Because if I add this also, then it will become 8 lakh. Then it is going more than 5 lakh. Alternatively, what I can say over here? I can also say policy number 1 and policy number 3. This 2 ka total is only 5 lakh, not more than 5 lakh. So this 2 policy will be exempt. But then this will be taxable. Any one policy you have to get it taxed. Acha, I can't say that policy 2 and 3 will be exempt because that total is now 7 lakh. That is more than 5 lakh. This combo is not useful. So either policy 1 and 2 exempt, or policy number 1 and 3 exempt, or policy number 3 alone can be exempt. It depends on assessee what he wants to claim. One more example. On or after 1st April 23, let's say 2 policies there. First policy ka premium is 4 lakh. Second policy ka premium 6 lakh. I have to see total of them, 10 lakh. More than 5 lakh? Yes. Taxability is there. But which policy is taxable? Only second one. Because the first policy ka premium is less than or equal to 5 lakh, I can give exemption to that. It will continue. See what I have written? Now if total premium of such policies exceed 5 lakh per annum, but still those policies covered therein whose premium do not exceed 5 lakh, those policy maturity will be exempt. Now we have some very good examples in this statutory update PDF itself. Let's see those examples. Example number 1. When the policy is issued 1st April 2013. Can I say if the policy is issued on 1st April 2013, that 5 lakh wala rule is not applicable. Now when this policy will be taxable? If the premium is paid more than 10, 15 or 20% of sum assured. Policy taken on 1st April 13. So we have to see 10% of sum assured. Sum assured is 60 lakh. Don't see maturity value. Sum assured is 60 lakh. So 10% will become 6 lakh. Premium paid exactly 6 lakh, not more than that. 5 lakh wala rule also not applicable because the policy is not issued on or after 1st April 23. Maturity will be completely exempt. This completely exempt. Would be exempt. Second example, date of issue 1st April 23. Yes, 5 lakh wala rule is applicable. But see, only one policy is there. And annual premium is exact 5 lakh, not more than 5 lakh. Then can I say it will not be taxable as per that 5 lakh wala rule? Then we have to see the rule of 10% of sum assured. Sum assured is 50 lakh. Premium paid exact 10% of sum assured, not more than that. Premium is not more than 5 lakh. Sum assured is not more than 10%. Policy will be what? Exempt. Maturity, whenever you will receive maturity, it will be exempt. Third example, policy taken on 1st April 2023. Premium is 6 lakh. Can I say more than 5 lakh? And only one policy is there whose individual premium is more than 5 lakh. Whenever this policy will get matured in the year of maturity, that is in the previous year 33-34, surplus will be taxable in IFOS. So it will not be exempt. In assessment year 34-35, it will be taxable. But only surplus will be taxable. Then example number 4. Two policy you have issued. Policy A, policy B. Both the policy issued on 1st April 2023. For same person, two policy. Now combined premium to be checked. 3 lakh and 2 lakh. Can I say 5 lakh? Not more than 5 lakh. Then this 5 lakh wala rule not applicable. Which rule is applicable? 10% of sum assured. 30 lakh sum assured. Premium paid 3 lakh. Exactly 10%. Sum assured 20 lakh. Premium paid 2 lakh. Exactly 10% of sum assured. Even premium is not paid more than 10% of sum assured. So total premium not more than 5 lakh. It is not more than 10% of sum assured also. Both the policy will be what? Exempt. Both the policy will be exempt. But example number 5. Date of issue both 1st April 23. So yes, that 5 lakh wala rule is applicable. Annual premium of both the policy combinedly, if we see 450 plus 550, then it will be 10 lakh rupees, more than 5 lakh. Then yes, taxability will be there. But that policy whose individual premium along with some other policy is less than 5 lakh, that will be exempt. So can I say policy A, premium is only 4,50,000, less than 5 lakh. Let make this policy exempt. However, this policy ka individual premium is also more than 5 lakh. This policy will be taxable. So policy will be A, exempt. Why exempt? Because individual is less than 5 lakh and it is exactly 10% of sum assured. So policy A exempt. Policy B, premium is more than 5 lakh. That will be taxable. So LIP B alone would not be exempt. LIP A will be exempt. See, again I am saying this to avoid any confusion. 5 lakh wali limit to be checked for both combinedly. But exemption can be given to those policy whose premium is less than 5 lakh. Now let's take an example over here. If instead of 550, here the premium would have been 4,60,000. Total of this two is more than 5 lakh. Yes, 5 lakh wala rule is applicable. Now I have an option. Which policy I want to exempt? I can exempt any one of them because see, individually their premium is less than 5 lakh. I cannot exempt both because both combinedly more than 5 lakh. I can exempt only one of them. Now which one of them is better for me to give exemption to this now, because maturity is more. So I will give exemption here to life insurance policy B and taxability will be with life insurance policy A. But this depends on case to case basis, as I said. Example 6. Again 3 policies are there. All 3 policies are issued on 1st April 23. So 5 lakh wala rule applicable for all. Annual premium 1 lakh, 350 and 6 lakh. If we do total of this, obviously it is more than 5 lakh. 5 lakh wala rule is applicable. But now those policies whose individual या total premium is less than 5 lakh, that will be exempt. So can I say policy number A and B ka premium is 1 lakh and 350. Total is going 4,50,000 only, less than 5 lakh. So this two policy I can give exemption. Policy C ka individual premium is more than 5 lakh. That policy will be what? Taxable. So here LIPC alone would not be exempt. A and B will be what? Exempt, because their total premium is less than 5 lakh. Example 7. Now 4 policies are there. X, A, B, C. But now see, policy number X is issued on 1st April 22. Prior to 1st April 23. It is not concerned with this 5 lakh wala rule. This policy was issued prior to 1st April 23. This 5 lakh wala rule is not at all applicable. It is separate. In this only one rule is applicable, 10% of sum assured. Premium paid is up to 10% of sum assured. Maturity will be exempt. But this 3 policies issued on 1st April 23. So we have to see total this 3 policy ka premium. Yes, this 3 policy ka premium is more than 5 lakh. Now again, those policies whose total premium is up to 5 lakh can get exemption. So these 2 policies can get exemption, same like earlier example. So this 2 will also be exempt. This alone will be taxable. You got it. This policy was issued prior to 1st April 23. That's why 5 lakh wala rule not to get applied on that. It is to be applied only on those policies which are issued on or after 1st April 23. So yes, here again LIPC alone would not be exempt. Balance all 3 will be exempt. Then example number 8. See, they have mentioned different case scenarios. I will say theory is only this much which I have given. This cover all the case scenario. Now based on this, you apply your mind and you solve the example. You don't need to see each and every case studies separately. Again 4 policies are there. 1st April 23, 1st April 24, 1st April 24, 1st April 24. Yes, all the policies are issued on or after 1st April 2023. So 5 lakh wala rule, for that all these policies will be considered. 450 plus 1 lakh plus 150 plus 6 lakh. Total is more than 5 lakh. And hence the taxability will be there. But those policies whose total is not more than 5 lakh will be exempt. Now what options I have? If I say this policy whose premium is 450, then okay, that will be exempt. I can't add any other policy with that, because the moment I add any other policy, the total will be more than 5 lakh. So alternate number 1, which says that policy X exempt, but then this 3 policy will be what? Taxable. ABC will be taxable. What other option I have, I can say that policy A and B exempt, because total of that is 250 only, less than or equal to 5 lakh. But if I add this 450, then total will be more than 5 lakh. So this A and B ka combo is also good. A and B exempt, but then X and C will be what? Taxable. So either A, B, C will be taxable, or only X and C will be taxable. Are you understanding my point, people? Okay. Then example number 9. X, A, B, C. Again, there are 4 policies taken on or after 1st April 2023. Total premium, if we see, total more than 5 lakh. Now you have to start the combo. Those combos of which total premium is up to 5 lakh can get exemption. So here X and A, total will be up to 5 lakh. Acha, A and B can also get combo 2 plus 250, that is also up to 5 lakh. Acha, X and B ka combo is also good to go, because that is exactly 5 lakh. Then remaining will be taxable. So either X and A exempt, B and C taxable. X and B exempt, then A and C taxable. A and B exempt, then X and C taxable. These alternative treatments are there. Last example. 5 policies are there. X, Y, A, B, C. If you see, all the policies are taken on or after 1st April 2023. Total premium of all this is more than 5 lakh. Then now we have to do the combo. Either we can say X, Y, total 4 lakh up to 5 lakh. If we add any one of them, total will go more than 5 lakh. So this 2 exempt, remaining 3 taxable. Or Y, A exempt, remaining 3 taxable. Or A, B exempt, remaining 3 taxable, because that is also total up to 5 lakh. Or X, B, total up to 5 lakh, exempt, remaining 3 taxable. Or Y, B, total up to 5 lakh, exempt, remaining 3 taxable. Any of this alternative is suitable. There are so many alternatives on that. Any alternative you can take and you can give exemptions thereon. Are you understanding my point, people? But remember, while looking at the premium, it was assumed that all this premium was exclusive of GST, that is before GST. And if it is term policy, then that policy will never be counted for this 5 lakh wali limit. That is totally exempted. For this 5 lakh wali limit also exempted, maturity is also exempted. So that was also one of the important amendment. I'm predicting this also in your examination. Somewhere as an MCQ or main question, somewhere this can come. Then TDS chapter. Section 194A. Any bank or post office paying interest more than 40,000, 10% TDS. If they are paying to resident senior citizen interest more than 50,000, 10% TDS. Any other person making payment of interest more than 5,000, 10% TDS. Now, last year in the budget, Nirmala Sitharaman Madam has issued one scheme, Mahila Saman Saving Certificate 2023, that any lady can invest up to rupees 2 lakh for 2 years and government will give 7.5% interest of 2 years. Just as a clarification, CBDT has said that on this scheme, whatever will be the interest, TDS will not be deducted. No TDS under 194A. It's just a clarification. Even though this clarification is not there, TDS was not applicable. Why? Because if you see, total interest is up to 40,000 only per year. But still, as a clarification they have said, so we have to remember that this Mahila Samman Saving Certificate, on that whatever interest will be given by post office, TDS will not be deducted. Then there is one section 194BA. Now what is 194BA? Whenever any winning is there, see, it is a newly incorporated section which you must have discussed in the classroom. Whatever is the winning of online gaming, of that winning, TDS will be deducted at 30% without any threshold. See, in 194B, 194BB, that is casual income and horse races, the threshold is 10,000. In 194BA, there is no threshold. Any winning on that 30% TDS is applicable. When TDS is applicable? At the time of withdrawal from your gaming account, or if not withdrawn, then at the end of the year, whichever is earlier. So question arises that there can be small players who are winning 30 rupees, 40 rupees in a month, in a year. To them also you will deduct 30% TDS. Then it will be a huge process to deduct TDS of each and every person, even in this small amount also. And that's why CBDT has given some guidelines to resolve this kind of difficulties. Now what that guidelines say? First point, if net winning is not more than 100 rupees in a month, TDS will not apply. If net winning is not more than 100 in a month, TDS will not apply. However, if all the month it is up to 100, then TDS will not apply. If in any one of the month winning exceed 100, then TDS will get applied in that month. TDS will deducted for entire year. Let's say in April month you got only 40 rupees, TDS not applicable. May month you won 60 rupees, TDS not applicable. In June month you won 120 rupees, it is more than 100 rupees, TDS will apply now onwards. But in June month you have to apply 30% on this 40 rupees also, on this 60 rupees also, because now it is more than 100 in one of the month. TDS will apply for entire year. If it is up to 100 in all the month, TDS not applicable in entire year. But if in any one of the month also it is more than 100, TDS applicable for entire year. However, if in any subsequent month amount exceed 100 in a month, TDS will be deducted entirely from subsequent withdrawal. Then, what if winning is in kind? Now this question has already been answered in so many sections. In 194B casual income, this question is there. 194R business benefit TDS, this question was there, that what if winning is in kind, then how to compute TDS? So whatever is the winning in kind, you have to calculate what is the value of that, apply 30%. So let's say to a gamer who won in online gaming, 1 lakh rupees he won, and I gave 1 lakh rupees ka mobile phone as a winning prize. So I know now that value is rupees 1 lakh. Of that 30% will become what? 30,000. First I have to call that winner, that give me 30,000 rupees. I will deposit it as a TDS under 194BA, and then only I will release this mobile phone to you. Unless and until TDS is deposited to government, you cannot release this winning in kind. If winning is in kind, before releasing benefit, you have to ensure payment of TDS. Call the TDS amount from winner, pay to government, then release winning amount, that is winning price. The same thing is there in 194B, the same thing is there even in 194R. Acha, how to value if it is in kind? That what is the value? How to identify that? If, let's say this mobile phone, the online gaming company has purchased and giving to this winner. Then see what is your purchase price exclusive of GST, because GST credit must have been taken. So let's say company has purchased the mobile phone from any store. 1 lakh plus 18,000 GST, total 1 lakh 18,000. Then yes, valuation of this winning is rupees 1 lakh. But what if Samsung company itself is giving this kind of winning? Then company has to think that how much price I would have charged if this phone is sold to some customer. That much price will become value of this winning. If it is from manufactured goods, price which is charged from other customer will become value. So let's say Samsung said that this mobile which I am giving as a winning, if I would have sold to customer, I would have charged 80,000 plus GST. Then yes, for the winner, what is the value of their benefit? 80,000. This rule is same in section 194R. This rule is same in section 194BA also. Small points are there. In MCQ this can come. Then you know that a very major change is there in TCS section 206C clause 1G. TCS on LRS, that is liberalized remittance scheme, overseas tour package. On this TCS is there, and in current year there is a huge amendment. From 1st October the rate has increased from 5% to some of the cases 20% TCS. And that amendment is already covered in the lectures because it is there in study material of ICAI. Some clarification CBDT has given that we need to discuss. That with regards to this amendment there were some doubts, difficulties that CBDT has cleared now. Now what are those clarifications? First, whatever remittance you are doing up to 7 lakh, generally no TCS, more than 7 lakh 5% or 20%. But if that remittance is through international credit card, this you must have studied in law subject, FEMA, international credit card. Whatever expense is done through international credit card, on that TCS is not applicable, because see, in that authorized agent is not covered. Na? You only load the money in this credit card and you use the money through this credit card. Authorized dealer never comes to know how much you have used through this credit card. So whatever expense you have done through this international credit card, on that TCS can never be applicable, because that authorized dealer of RBI can never come to know how much you have spent upon. Second, for LRS, 7 lakh rupees is the threshold of the entire year. But understand, in LRS there can be so many payments. Na? For education payment is there, for medical treatment payment is there. Question is whether the 7 lakh rupees of limit is separate for educational facility, medical facility, so on and so forth. No. For all the LRS together the limit is 7 lakh. 7 lakh threshold is combined and not separate for LRS. Like education, medical, together 7 lakh limit is there. However, LRS ki limit, overseas tour operator package ki limit, those are separate. That we know. That overseas tour operator package ka limit is separate, LRS ka limit is separate. Acha, second, I have said that from 1st September there is huge changes. Na? From 1st September there is a changes in rate of TCS. That doesn't mean that 1st September say threshold is also separate. No. In lecture also I have said this. 7 lakh ka threshold is same for 1st April to 31st March. Threshold don't change. Threshold is entirely for year. The rate changes. Though the rate of TCS in this section changes from 1st September, but the limit of 7 lakh is combined for whole year and not for that 6 month. Achha, obviously here 1st October is there. So even though the rate changes from 1st October, but the threshold of 7 lakh is for same entire year. This is somewhat very important. Up to now, people were of the opinion, which was clearly evident from other sections, that the limit is per payer per pay, meaning thereby you change authorized dealer and the 7 lakh rupees of limit will also get changed. So threshold is per authorized dealer. Easily you can send any amount outside India by changing authorized dealer. In this case, CBDT has clarified limit of 7 lakh is not per authorized dealer. Combinedly, for all the authorized dealer together, if you remit amount more than 7 lakh, your TCS will get applied. So let's say I went to authorized dealer A. I said I want to remit 7 lakh rupees outside India. 7 lakh rupees remitted, no TCS, it's okay because it is up to 7 lakh. I went to authorized dealer B during the financial year. I said I want to remit 2 lakh rupees outside India. Now, same person is remitting total 9 lakh. Earlier 7 lakh, now 2 lakh. On this 2 lakh, second authorized dealer need to collect my TCS. The limit is not separate, it is combined. Question arises, how the second authorized dealer will come to know that my total remittance is more than 7 lakh? Here, responsibility is casted upon me. While going to second authorized dealer, I have to furnish a declaration that how much remittance I have done through other authorized dealer during the year prior to this transaction. And based on this declaration, that authorized dealer will start collecting my TCS. What if declaration is given wrong? Strict actions will be taken. CBDT has given a warning. As of now, there is no RBI system from where earlier remittance through other authorized dealer can be known. System is getting developed. Hence, remitter has to give an undertaking every time about past remittance during the year so that the new authorized dealer can come to know that what is the total remittance up to now. Authorized dealer can calculate TCS accordingly. False undertaking, appropriate actions will be taken. One last question arises that on international tour package, you are saying that TCS is there without any threshold. But what is tour package? Booking only traveling tickets, whether it is tour package. Yeah, booking only hotel accommodation, whether it is a tour package. Then the answer is only international travel ticket or only hotel accommodation is not a tour package. Package should include at least combo of 2 expense, either hotel plus tickets plus any facility in that country. Any 2 facility should be there given by one agent. If any 2 facility also given, then it is a package. If any 1 facility is given, that is only travel tickets given or only hotel accommodation is given, it is not a tour package. Then TCS will not get applied. That is as per this CBDT circular. Then assessment procedure chapter. You know na that there is some rules. Section 139A permanent account number, below that there is a circular. There are some transactions, if you enter in those transactions, you have to furnish permanent account number. For example, opening a account in a bank, then putting a fixed deposit more than 5 lakh in a year, opening a demat account, taking credit card, debit cards, purchasing immovable property more than 20 lakh rupees, purchasing or selling any goods or services more than 2 lakh rupees. All this, many other transactions are there. You have to furnish permanent account number as your KYC document. And if you don't have permanent account number, because you are not eligible to take it or you are not covered in 139A, you have to furnish a declaration in form number 60 that I don't have a permanent account number, and hence form number 60 will be submitted. As per CBDT circular, certain transactions need PAN as KYC document. However, if the person entering transaction do not have PAN, he needs to file declaration in form number 60. Now, one exception is created. A foreign company who is entering into any transactions in IFSC banking unit. See, IFSC banking unit, International Financial Service Center, Gift City. Basically, as of now, only one IFSC unit is there, Gift City, Gandhinagar, Ahmedabad, near Ahmedabad, Gujarat. If in Gift City, you have a banking unit, because in that foreign currency transactions are also permitted. And so many concessions are given if you operate something in Gift City. In CA final, we'll learn all this. If in Gift City, a foreign company open any bank account, such foreign company do not have any taxable income in India. They have all the taxable income outside India. And hence they are not having permanent account number also. For opening bank account, for any amount, they don't need permanent account number. They will furnish form number 60. If they have a fixed deposit with any bank in Gift City, one time fixed deposit is more than 50,000, yeah, aggregate in a year more than 5 lakh. Generally they have to furnish PAN, but if they don't have permanent account number, they will furnish form number 60. This concession is given to foreign company who is having bank account in a Gift City, but this foreign company should not be having any taxable income in India, not be having permanent account number. For this 2 transaction, what they will furnish? A declaration in form number 60. Similar kind of exemption is given for rule number 114BA. Who are supposed to take permanent account number? These 3 amendments you must have studied during the classroom also. That so many people are supposed to take permanent account number, whose total income is more than basic exemption limit, who undertake a financial transaction more than 2.5 lakh, whose turnover is more than 5 lakh in a year. 3 more cases are added. Who deposit cash in bank or post office more than or equal to 20 lakh. Who withdraw cash from bank or post office more than or equal to 20 lakh. Yeah, a person who open current account or cash credit account, they are supposed to furnish permanent account number. They are supposed to take permanent account number, and they are supposed to furnish permanent account number also. This you have studied. But now CBDT has given some concession that if a non-resident is there or foreign company is there who opens any bank account in IFSC banking unit and they does not have taxable income in India and they do not have permanent account number, it's okay if they enter this two transaction. They are not supposed to take permanent account number. They are not supposed to furnish permanent account number. But remember, this concession is given to whom? Non-resident or foreign company who is entering transactions where IFSC banking unit, that is in GIFT City, and they should not be having any taxable income in India. Then only they are not supposed to take permanent account number of India, even though they enter into these transactions. If you ask me personally, these two amendments which we just discussed of assessment procedure chapter, mainly relevant to CA final, because non-resident taxation mainly come in CA final. Still, in inter-statutory update PDF they have given these amendments, and that's why it was my duty to teach. I have taught this, but not that important for exam. What is much more important is two things. First, obviously this accommodation. Second is this IFOS wala point. Third important, TDS TCS. Last is list important. So A, B, C category also I have given to you. Apart from that, those amendments which are there in ICAI material, like amendment in section 115 BAC is there, newly incorporated section 115 BBJ online gaming taxability, so 115 BAC, then 115 BBJ online gaming winning, and that's TDS 194 BA, of which some discussions we had. 206C clause 1G TCS on overseas tour operator package and remittance of LRS on that TCS rate changed and all. 80CCH Agnipath scheme employee contribution, employer contribution exemptions. Assessment procedure and generally don't have much amendments. Main amendment is there in 115 BAC, but 2-page amendment is there. People are creating hype. 115 BAC changed. Now it is default tax regime. What will happen? Or nothing will happen. If they are saying calculate tax as per default tax regime, calculate as per 115 BAC. If they say shift out, calculate as per old regime. Calculation method remains same. And only few changes in slab rates are there, rebate is there, surcharge is there. In 115 BAC changes are there. 2-page amendments are there. Don't create hype of amendments. These amendments you can easily discuss. These are the amendments. If you have any doubt in the statutory updates or in these amendments, you can contact to any of the DT faculty of JK Shah classes, including me. Any of us will be really happy to solve your doubts. All the very best for May 24 preparation and the examinations. I know you will create wonders in the exam. Thank you so much.